Stop what you're doing for a second, because the story unfolding right now is not just another headline. It's a warning flare. It's a countdown. And if you've been watching the dollar, watching gold, watching silver, watching the way governments talk when they're getting nervous, then you already feel it. Here's the punchline up front. 2026 is shaping up like the year where the cracks stop being hairline and start becoming visible from space. The kind of year where people look back and say, that was the moment it turned. And yes, we're going to talk about gold and silver. We're going to talk about the Middle East. We're going to talk about why markets can look calm right before they go feral. And we're going to connect the dots that most people never connect because they're too busy arguing over symptoms while ignoring the disease. But before we jump in, I need to be real with you for a second. My channel analytics are screaming something at me. A huge chunk of you who watch these videos, you're not subscribed. You're here, you're learning, you're getting value, and then you disappear like a ghost. If this content helps you even a little, do me a favor, hit subscribe right now. We're aiming for 50,000 subscribers in the next 30 days, and I can't hit that target without you. Also, we're now posting members exclusive videos on a regular basis, and this isn't recycled content. A dedicated team is working behind the scenes to build these deep dive updates only for you, our special members in the John A.G. family. If you want in, click the join button right now or use the link in the description. The morning sun rises over Manhattan's financial district. Traders settle into their desks, computer screens flicker to life. Another day begins in the world's most powerful financial system. Nobody notices the invisible crack forming beneath their feet. The SWIFT network hums with activity. Trillions of dollars move across borders in milliseconds. Banks in Tokyo send payments to London. European firms settle accounts with American suppliers. The dollar flows like blood through the veins of global commerce. It has worked this way for decades. Everyone assumes it will work this way forever. In Washington, the Treasury building stands tall and imposing. Its neoclassical columns project permanence. Inside these walls, bureaucrats manage the world's reserve currency. They issue bonds that foreign nations eagerly purchase. They print dollars that the entire planet needs. This power seems eternal. But history teaches a different lesson. 55 years earlier, a television set displays President Nixon's face. The date is August 15, 1971. Nixon speaks to the American people. He announces that the United States will no longer convert dollars to gold. The Bretton Woods system dies in that moment. Economists call it the Nixon shock. But something unexpected happens next. Instead of collapsing, the dollar becomes more powerful. American officials recognize an opportunity. They need a new foundation for monetary dominance. The answer lies in the deserts of the Middle East. 3 years later, in 1974, American diplomats meet with Saudi officials. They propose an arrangement. Saudi Arabia will sell its oil only in dollars. In exchange, America will provide military protection and purchase Saudi debt. The Saudis agree. Other OPEC nations follow. The petrodollar system is born. This mechanism creates automatic global demand for American currency. Every nation needs oil. Oil trades only in dollars. Therefore, every nation must hold dollars. It is elegant. It is powerful. It is the foundation of modern American empire. Central banks around the world begin accumulating treasury securities. They have no choice. To buy oil, they need dollars. To get dollars, they must either export to America or buy U.S. government debt. The system feeds itself. It grows stronger each year. By the 1990s, the dollar represents 60% of global reserve holdings. No other currency comes close. The euro exists, but remains secondary. The yen serves regional purposes only. The yuan is not yet convertible. The dollar reigns supreme and unchallenged. American consumers enjoy remarkable benefits. Imported goods arrive cheap. Electronics, clothing, automobiles all cost less than they should. The rest of the world essentially subsidizes American living standards. This is what economists call exorbitant privilege. The United States runs massive trade deficits year after year. Under normal circumstances, such imbalances would destroy a currency. But these are not normal circumstances. The world needs dollars for oil. They accept treasury bonds in payment. The deficits never seem to matter. Other nations must work differently. They must export goods to earn dollars. They must maintain trade surpluses. They must accumulate reserves to protect against crisis. They live under different rules. America writes the rules. This asymmetry defines the global financial order. The dollar system does more than enable cheap imports. It funds American military projection worldwide. The Pentagon operates 750 bases in 80 countries. This presence costs hundreds of billions annually. No other nation could afford such deployment. But America pays in dollars it prints. The rest of the world holds those dollars as reserves. For 5 decades, this architecture appears unbreakable. Economists write papers about dollar dominance. They conclude it will continue indefinitely. Financial textbooks treat it as permanent fact. The system has lasted so long that people forget it was designed by humans. And anything designed by humans can be redesigned. Then comes February 2022. Russian tanks cross the Ukrainian border. The invasion shocks the world. Western governments convene emergency meetings. They must respond. They must punish Moscow. But how? Someone proposes an unprecedented action. Freeze Russian central bank reserves. Make their dollar holdings inaccessible. Cut them off from the international financial system. The proposal seems brilliant. It weaponizes the dollar itself. Within days, the decision is made. $300 billion in Russian assets become frozen. Moscow's financial system faces immediate crisis. Western officials celebrate. They have used American monetary power as a weapon. It appears to work perfectly. But in capital cities across Asia, Africa, and Latin America, finance ministers watch carefully. They see what has happened. They reach a quiet conclusion. Dollar reserves are not actually safe. Today, Russia faces sanctions. Tomorrow, who knows? Any nation could face similar treatment. Central bank governors begin discreet conversations. They order strategic reviews. They study historical currency transitions. They ask their teams uncomfortable questions. What if we need to reduce dollar dependence? What alternatives exist? How quickly could we diversify? The invisible crack appears in the foundation. Nobody on Wall Street notices it yet. The markets continue functioning normally. But deep in the machinery of global finance, something fundamental has changed. Trust has been damaged. And in monetary systems, trust is everything. 6 months pass after the sanctions. The world appears normal. Stock markets rise and fall with their usual rhythm. Currency traders watch their screens. Business continues as always. But in private conference rooms across 3 continents, something remarkable is happening. The managers of the world's wealth are making decisions that will reshape global power. In Beijing, a team of economists gathers around a long table. Charts cover the walls. These charts show China's treasury holdings. For years, China has been America's largest foreign creditor, over $1 trillion in U.S. government bonds. This money sits in vaults, earning interest, supporting American deficit spending. But the team is discussing a new strategy. The lead economist stands and points to a specific chart. It shows bond maturity dates. Some bonds expire this month, others next month. Normally, China rolls these bonds over. They take the proceeds and buy new treasuries. It happens automatically. But today, the economist proposes something different. Let some bonds mature without replacement. Not dramatic selling, just quiet non-renewal. The logic is simple but powerful. China does not want to trigger market panic. Dumping treasuries would crash prices and hurt China's remaining holdings. That makes no sense. Instead, they will gradually reduce exposure, like a dinner guest who slowly backs away from the table. Polite, careful, but deliberate. Across the sea in Tokyo, Japanese officials face similar calculations. Japan holds nearly as many treasuries as China. The U.S.-Japan alliance runs deep. Military cooperation, trade relationships, decades of partnership. Yet even Tokyo feels nervous after watching Russian reserves freeze overnight. A senior Japanese finance official meets with colleagues behind closed doors. He speaks carefully. "We are not abandoning the alliance," he says, "but prudence requires diversification." The others nod. They understand. Friendship is one thing. Financial survival is another. Japan begins its own quiet reduction in treasury purchases. Meanwhile, something extraordinary unfolds in the Middle East. A luxury hotel in Riyadh hosts a meeting that will make history. Chinese financial officials sit across from Saudi representatives. They discuss currency arrangements. For decades, such meetings would have been unthinkable. Saudi oil sold only in dollars. That was the rule. That was the foundation of petrodollar power. But the Chinese delegation makes a compelling offer. Buy our goods in yuan. Sell us oil in yuan. We eliminate currency conversion costs. We reduce dollar dependency. Both nations benefit. The Saudis listen carefully. They remember how quickly Russian reserves disappeared. They wonder if their own dollar holdings are truly safe. Weeks later, the first major oil transaction settles in yuan. The volume is significant. 20 million barrels. Payment flows through Chinese banking systems. No dollars involved, no SWIFT messages. The transaction completes smoothly. Western financial media barely reports it. A small article appears on page 6 of the Financial Times. Most readers skip past it. They do not understand what they are witnessing. But in Abu Dhabi, officials take notice. The United Arab Emirates announces it will accept Indian rupees for oil trade. The Indians have been requesting this for years. Now the Emirates agrees. Another crack appears in petrodollar dominance. Still, Western analysts dismiss these developments as minor experiments. They say the dollar's position remains secure. Russia and India create their own payment mechanism. Rupees and rubles flow directly between central banks. No dollar intermediation required. The system works. Trade continues despite Western sanctions. Other nations observe this success. They begin asking questions. Could we do something similar? In South Africa, Brazil, and other emerging markets, finance ministries start research projects. They study alternative payment systems. They model scenarios. They calculate costs and benefits of dollar reduction. These studies remain classified. Governments do not announce their contingency planning, but the work proceeds intensively. A new term enters the vocabulary of central bankers, BRICS alternative architecture. The BRICS nations, Brazil, Russia, India, China, South Africa, begin serious technical discussions. Not just talk anymore, actual engineering. Software developers write code, payment protocols get tested, central bank digital currencies connect experimentally. The mBridge project moves from theoretical concept to operational testing. 4 central banks link their systems directly: Thailand, China, UAE, and Hong Kong. They process real transactions. The technology works. Settlement happens in seconds. No correspondent banks needed, no dollar conversion required, no SWIFT involvement. The test succeeds beyond expectations. Simultaneously, something unusual happens in gold markets. Central banks have historically been net sellers of gold. They preferred treasury bonds. Gold pays no interest, bonds do. The choice seemed obvious. But after 2022, the pattern reverses dramatically. Emerging market central banks become aggressive gold buyers. In 2023, they purchase over 1,000 tons. This shatters all previous records. Market analysts struggle to explain it. They write reports about diversification and portfolio rebalancing. They miss the real story. Central banks are buying gold because gold cannot be frozen. Gold cannot be sanctioned. Gold sits in physical vaults under sovereign control. The buying continues into 2024. By year-end, official sector gold purchases exceed even 2023's record. Poland buys, Turkey buys, China buys, India buys, Singapore buys. Each transaction is public. Each transaction is legal. But collectively, they represent a vote of no confidence in the dollar system. Western central banks notice these trends. Internal memos circulate at the Federal Reserve. Economists model the implications. What happens if foreign treasury demand disappears? Who will buy U.S. government debt? The questions make officials uncomfortable. They have no good answers. American debt issuance continues accelerating regardless. The government needs funding. Congress passes spending bills. The Treasury must sell bonds. Auctions happen every week. But increasingly, the Federal Reserve itself becomes the buyer. Not foreign central banks, not private investors. The Fed. By late 2025, the Federal Reserve holds a record percentage of outstanding Treasury debt. This is not normal. This is not healthy. This is what happens when natural demand evaporates. The central bank becomes buyer of last resort. It prints money to buy government debt. Economists have a name for this: monetization. It has never ended well historically, yet markets remain eerily calm. Stock indices hover near record highs. The dollar trades in familiar ranges. Volatility stays low. Casual observers see no crisis. Everything appears fine on the surface, like a frozen lake in early spring. The ice looks solid, but underneath, the structure is weakening. The exodus accelerates through autumn. More nations reduce dollar reserves. More oil trades settle in alternative currencies. More payment systems bypass traditional channels. Each development alone seems minor, but they accumulate, they compound. The foundation erodes one grain at a time. A glass tower in Singapore houses one of Asia's most sophisticated financial institutions. Inside, a team of software engineers stares at rows of green text scrolling across black screens. They are not building a video game. They are not creating a social media app. They are constructing the infrastructure that will replace the dollar system, and they are ahead of schedule. The lead engineer explains the technology to visiting central bank officials. His voice carries quiet confidence. Traditional cross-border payments take 3 to 5 days, he says. Our system settles in 8 seconds. The officials lean forward. 8 seconds. No correspondent banks. No SWIFT codes. No dollar conversion. Just direct central bank to central bank transfer. The future arrives faster than anyone expected. This is mBridge. The name sounds technical and boring, but boring technology often changes the world. Email was boring. The internet seemed like a toy for academics, yet these boring technologies destroyed entire industries. Now mBridge threatens to do the same to dollar dominance. The system works through distributed ledger technology. 5 central banks currently participate: Thailand, China, United Arab Emirates, Hong Kong. Saudi Arabia recently joined as observer. They test real transactions, not simulations, actual payments for actual goods. A Thai importer buys Chinese electronics. Payment flows in seconds. Settled. Verified. Complete. No dollars touch the transaction. The beauty of the system lies in its simplicity. Businesses hate complexity. They hate waiting. They hate fees. mBridge eliminates all 3 problems: fast settlement, minimal fees, direct connection. Why would anyone choose the old system when this alternative exists? Across the ocean, Brazilian officials meet with their Argentine counterparts. The relationship between these nations has been complicated historically. Competition, suspicion, different political philosophies. But they agree on one thing: dollar dependency must end. They announce a bilateral settlement mechanism. Trade between Brazil and Argentina will occur in local currencies, Brazilian reals and Argentine pesos, no dollar intermediation. The announcement makes headlines in South America. It barely registers in New York. American financial media dismisses it as regional news. They do not understand the pattern forming. Southeast Asia moves next. ASEAN nations launch their own regional payment connectivity system. Indonesia, Malaysia, Philippines, Singapore, Thailand, all linking their financial infrastructure. The system allows tourists to pay with home country apps anywhere in the region. Businesses settle invoices in local currencies. The dollar becomes optional, not mandatory. In Africa, something even more ambitious takes shape. The African Continental Free Trade Area represents 1.3 billion people, 54 nations, enormous potential. But historically, African nations traded through Western financial systems. A shirt manufactured in Kenya and sold in Nigeria would settle in dollars or euros. The absurdity of this arrangement finally sparks action. African central banks begin technical discussions about continental payment infrastructure. They study the Asian models, they hire engineers, they allocate resources. The project will take years to complete, but the decision has been made. Africa will build its own financial architecture. Each of these initiatives operates independently. Nobody coordinates them centrally, yet they all point the same direction, away from dollar dependence, toward regional autonomy. The pattern becomes impossible to ignore for anyone paying attention. An economics professor in London publishes a paper explaining what is happening. He uses the term network effect in reverse. The dollar became dominant because everyone used it. The more people who used dollars, the more valuable dollars became. This created a self-reinforcing cycle, but network effects work both ways. As alternatives emerge, the cost of using dollars relatively increases. Why pay conversion fees when direct settlement exists? Why hold treasury bonds when they might get frozen? Why accept counterparty risk when alternatives eliminate it? Each entity that leaves the dollar network makes leaving slightly easier for the next entity. The professor's paper circulates through central banking circles. Governors read it carefully. They recognize their own reasoning reflected in the analysis. They understand they are part of a larger pattern. This understanding accelerates the process. FOMO, fear of missing out, affects central bankers too. Nobody wants to be the last one holding dollars when the music stops. Currency swap agreements multiply across the developing world. These agreements allow two nations to trade using their own currencies. China and Brazil establish a swap line. Russia and Iran create another. India and UAE announce theirs. Each agreement represents another bypass around the dollar system. The numbers become staggering. By mid-2025, over 90 bilateral currency swap agreements exist globally. Most were created in the previous 3 years. The infrastructure for dollar-free trade now spans the planet. It is no longer theoretical. It is operational. A historic meeting convenes in Kazan, Russia. BRICS leaders gather for their annual summit. But this year feels different. Previous summits produced declarations and joint statements. This summit produces technical specifications. Engineers present blueprints. Central bankers review implementation timelines. The BRICS currency unit moves from concept to concrete proposal. The mechanism is sophisticated, not a single currency replacing the dollar. That would be too simple, too vulnerable. Instead, a basket system, weighted by GDP and trade volume. Partially backed by gold, designed for settlement between central banks, not as circulating currency. The technical committee has done serious work. Gold backing proves particularly interesting. BRICS nations collectively hold massive gold reserves. Russia, China, India, even smaller members have been accumulating metal. A gold-backed settlement unit offers something the dollar cannot provide. Physical backing, tangible value, protection against inflation and political manipulation. Commodity-rich nations immediately see the advantage. Venezuela has oil, Bolivia has lithium, South Africa has platinum, Brazil has iron ore. A settlement system tied to real commodities makes intuitive sense to these countries, better than trusting paper issued by a distant government. Meanwhile, the United States faces a different problem. The fiscal position deteriorates rapidly. Federal debt crosses $36 trillion. The number is so large it loses meaning. Humans cannot conceptualize $1 trillion of anything, but the consequences become real regardless of human comprehension. Interest payments on this debt approach $1 trillion annually. Think about that. $1 trillion, not going to infrastructure, not going to education, not going to healthcare, just interest, just the cost of borrowing. This burden was manageable when other countries eagerly bought treasuries, but that eagerness has vanished. The Treasury Department issues bonds every week. They must. The government needs money, but auction results grow weaker. Foreign participation declines steadily. Primary dealers, the banks obligated to buy, take down larger percentages, and they immediately sell to the Federal Reserve. The charade becomes obvious to market professionals. Think tanks in Washington begin publishing worried analyses. The language is careful, academic, diplomatic. They write about gradual erosion of dollar preference. They discuss orderly transition to multipolar currency system. They suggest proactive policy responses to changing circumstances. Nobody uses the words that actually describe what is happening: collapse, crisis, catastrophe. The policy establishment cannot acknowledge reality. To acknowledge would be to admit failure. To admit failure would require change. Change threatens entrenched interests. So the polite fiction continues. The dollar is fine. Adjustments are normal. Nothing to worry about. But young entrepreneurs building businesses see something different. They watch commodity prices. They track currency trends. They read technical papers about payment systems. They understand that the world is reorganizing, and they begin repositioning their companies accordingly. Smart businesses start holding gold, not paper gold certificates, physical metal in secure vaults. Other companies accumulate silver. Some buy productive farmland. Others invest in energy infrastructure. The common thread is tangible assets, things that hold value regardless of currency systems. The business community adapts faster than politicians. Entrepreneurs must adapt to survive. Governments can pretend. Corporations cannot. Balance sheets reflect reality. Quarterly earnings effectively cannot be faked for long. So corporate treasurers quietly diversify. They hedge dollar exposure. They prepare for instability. By December 2025, the alternative architecture is complete. Not perfect, not universal, but operational, functional, ready for stress testing, and stress is coming. The new year arrives with tension hanging over global markets like storm clouds before lightning strikes. January 2026 opens not with celebration, but with anxiety. Traders return from holiday break to find their screens filled with red warnings. Geopolitical risk indicators flash alerts. Volatility indexes spike. Something feels different this time. In the Middle East, military movements accelerate. Satellite images show troop deployments near critical choke points. The Strait of Hormuz, through which 20% of global oil flows, becomes a focus of international concern. Naval vessels from multiple nations position themselves strategically. Diplomatic channels buzz with urgent messages. The world watches nervously. Simultaneously, tensions in the Taiwan Strait reach levels not seen in decades. Chinese military aircraft cross median lines daily. American carrier groups patrol international waters. Japanese defense forces go on heightened alert. South Korea watches carefully. The situation is not yet crisis, but it is no longer routine posturing either. For the first time in modern history, the United States faces simultaneous strategic challenges on opposite sides of the planet. This is not coincidence. Adversaries coordinate timing deliberately. They understand American military power, while vast, cannot be everywhere at once. They probe for weaknesses. They test resolve. They watch how Washington responds. Historically, such moments required unquestioned dollar dominance. When crises emerged, the world needed dollars for safety. Capital flowed to America. Treasury bonds became the ultimate safe haven. This dynamic reinforced American power at precisely the moments it faced challenge. But 2026 is different. The financial architecture has fundamentally changed. A major Gulf oil producer makes an announcement that reverberates through energy markets. Effective immediately, all oil sales offer a UN pricing option. Not experimental, not bilateral. Standard practice for any buyer who wants it. The statement is diplomatic. It emphasizes continued dollar acceptance. But the message is clear. The petrodollar monopoly has ended. European finance ministers convene emergency video conferences. They discuss scenarios their staffs have been modeling privately for months. What if dollar liquidity becomes unreliable? What if the Federal Reserve prioritizes domestic concerns over international stability? What if another sanctions episode creates panic? These questions demand answers. France proposes accelerated development of euro-based settlement systems. Germany expresses caution but agrees to study options. Italy worries about American reaction. The discussions remain classified. Official statements emphasize transatlantic partnership. But behind closed doors, contingency planning intensifies. Even allies prepare for dollar system failure. The Federal Reserve faces a policy nightmare that has no good solution. Inflation pressures remain elevated. Normally, this requires higher interest rates. But higher rates make Treasury borrowing more expensive. With $36 trillion in debt, every percentage point increase costs hundreds of billions annually. The fiscal mathematics become impossible. Alternatively, the Fed could maintain loose monetary policy, keep rates low, make government borrowing cheap. But this approach accelerates international dollar flight. Foreign holders watch American monetary policy closely. If the Fed chooses inflation over sound money, reserve managers will dump treasuries faster. The Fed is trapped between terrible options. Treasury auctions provide the evidence. Each week the government sells billions in new bonds. The results grow progressively weaker. Foreign participation hits multi-decade lows. Primary dealers take down larger percentages, then immediately flip bonds to the Federal Reserve. The central bank prints money to buy government debt. This is the definition of monetary financing. This is how currencies die. Bond yields rise steadily. Not from economic growth, not from inflation expectations alone, from trust deficit. When buyers doubt they will be repaid in currency worth something, they demand higher yields. The risk premium for holding treasuries increases week by week. America's borrowing costs rise accordingly. American businesses suddenly face currency risks they have never experienced. For decades, U.S. companies operated assuming dollar stability. They priced products in dollars. They signed contracts in dollars. They never worried about exchange rate volatility. Now, currency hedging becomes essential. Corporate treasurers scramble to protect balance sheets. Import prices begin sustained upward movement. Container ships arriving from Asia carry goods priced higher than months before, not just from tariffs or transportation costs, from currency adjustment. The dollar buys less than it used to. American consumers have not experienced this phenomenon in their lifetimes. They struggle to understand why everything suddenly costs more. The exorbitant privilege that economist Barry Eichengreen described decades ago begins unwinding in real time. For 50 years, America imported more than it exported. Other nations accepted paper dollars in exchange for real goods. This arrangement suppressed American inflation and elevated living standards artificially. Now the arrangement reverses. Industries that relied on cheap imports face sudden margin compression. Retailers cannot pass all costs to consumers. Manufacturers cannot absorb all input price increases. Some businesses fail, others lay off workers. The economic adjustment happens faster than policy can respond. Strategic commodity access becomes corporate priority overnight. Companies that ignored supply chain geography suddenly care deeply. Where does lithium come from? Who controls rare earth deposits? What happens if commodity exporters refuse dollar payment? Questions that seemed academic in 2023 become urgent in 2026. Gold and silver markets experience extraordinary demand, not from speculators, from institutions, pension funds, insurance companies, university endowments, serious money seeking serious protection. They have watched central bank gold buying for 3 years. Now they join the trend. Premiums for physical metal over paper prices reach historic levels. Energy assets attract similar institutional interest. Oil wells, natural gas fields, renewable energy infrastructure, anything that produces actual energy. Financial assets can evaporate overnight. Energy powers civilization. The logic is simple. The capital flows are massive. The business community adapts with remarkable speed. Entrepreneurs understand survival requires flexibility. They cannot wait for government policy. They cannot depend on political solutions. They must position their companies for the world that is emerging, not the world that was. Young business leaders study monetary history. They read about Weimar Germany. They examine the collapse of the pound sterling. They analyze the Asian financial crisis. They learn that currency transitions create opportunities for those prepared and disasters for those caught unaware. They choose preparation. Meanwhile, in Washington, paralysis reigns. Congress argues about blame rather than solutions. One party claims the other caused the problem. Both parties actually contributed over decades. Deficit spending under every administration. Monetary expansion under every Fed chairman. Sanctions overused by multiple presidents. Collective failure produces collective crisis. No coherent strategy emerges from political leadership. Some officials deny problems exist. Others acknowledge problems but propose contradictory solutions. Hawks want military assertion to prove American strength. Doves want diplomatic engagement. Economists want fiscal discipline. Politicians want easy answers that preserve their positions. The bureaucracy produces reports and recommendations that gather dust. Everyone knows what should be done. Reduce spending, reform entitlements, rebuild manufacturing, restore fiscal discipline, but knowing and doing are different things. Political incentives reward short-term thinking. The long-term consequences become someone else's problem. International institutions prove equally ineffective. The International Monetary Fund issues warnings that nobody heeds. The World Bank publishes studies that confirm what everyone already knows. The Bank for International Settlements writes careful analyses that change nothing. These institutions were designed for the old world. The new world bypasses them entirely. By spring 2026, the pattern becomes undeniable even to casual observers. The dollar share of global reserves drops below 55% for the first time since the 1980s. Oil transactions and alternative currencies exceed 30% of global volume. BRICS nations settle over half their mutual trade without dollars. The numbers tell a story that words cannot obscure. Financial historians begin writing the first drafts of what happened. They describe not a sudden collapse, but a structural unraveling. Like a sweater with one loose thread. Pull the thread and the whole garment comes apart. The sanctions on Russia in 2022 pulled the thread. The unraveling took 4 years, but once started, it proved irreversible. The trajectory is now clear. American living standards will adjust downward. Not catastrophically, not overnight, but persistently. The gap between American wages and global wages will narrow. The artificial subsidy provided by reserve currency status will disappear. The adjustment will feel unfair to those who never understood the privilege existed. Some nations will benefit from this transition. Commodity exporters will enjoy improved terms of trade. Manufacturing centers will see increased investment. Countries that built productive capacity while America, financialized, will gain relative advantage. The global economic order is reorganizing around new principles. For individuals and businesses, the message is clear. The world is not ending, but the world is changing. Those who recognize the change early can position accordingly. Those who deny the change will suffer consequences. Reality does not care about denial. The difference between prediction and preparation matters enormously. Predicting the exact timing of currency shifts is impossible. Preparing for inevitable transitions is wise. Smart money prepares. Smart businesses diversify. Smart individuals acquire skills and assets that hold value across systems. As summer approaches, one thing becomes certain. The question is no longer whether dollar dominance will erode. The question is how quickly and how disorderly the transition will be. The unraveling has started. The trajectory is set. What comes next depends on choices made today.